Hello and welcome. As every week, we are going to talk about some of most shorted stocks. Be sure to subscribe and drop your comments. Now, let's dive in.
Let's dive into a real market mystery, all about a little biotech stock called Pasthea Therapeutics. So the company puts out great news, but then shorts attack it by 16,000%. How does that even happen? Yeah, it was a tale of two tapes. You've got good clinical news on one side, and the market screaming disaster on the other. And you know what's crazy? This whole contradiction, it all comes down to one single event. Okay, so before all this, Pasthea was worth about $25 million, a pretty typical small biotech. Then, bam, they announce a $60 million offering. That's more than double the company's entire value. And look at this, a flood of new shares. We're talking about 5 times the original amount just hitting the market. This created the perfect setup for a strategy called dilution arbitrage. Let me show you how it works. And here's the genius of the trade. Get cheap shares, short at a higher price, then cover. It's almost a risk-free profit. The result was just insane. Short interest absolutely exploded, up 16,000% in just a couple of weeks. All of this action puts some serious stress on the market's plumbing, behind the scenes. Get this, at its peak, the fee just to borrow the stock was over 600% a year. That's like paying over 1.5% of your money every single day. Just brutal. As one report put it, it basically turned the stock into a game of hot potato for the shorts. And a lot of this was happening in the shadows, away from the normal public exchanges. On the busiest days, check it out, over half the shorting was done on these private exchanges, or dark pools. So now the stock is basically trapped. It's got a ceiling of new shares above it and a floor of new cash below it. Okay, so after all that, what's the big lesson here? What are we supposed to take away from this whole thing? It's this. Sometimes the market's plumbing, the structure, matters way more than the company's actual good news. Which leaves us with a huge question. When a company's story and the market's plumbing collide, what really sets a stock's price?
Okay, so a biotech stock absolutely explodes. But what happens next is a total Wall Street battle.
Yep, a 371% jump for Capricor Therapeutics in a single day. What could cause a move like that?
The news was a potential game changer for patients with Duchenne muscular dystrophy.
So, why did it immediately become a target for short sellers? Let's unpack this paradox.
First off, the good news was legit. Capricor's HOPE-3 drug trial, it met its goals.
This put them on track for potential FDA approval in only 6 months. That's what started the rally. But a huge stock pop like that, it's the perfect time for a company to raise some cash.
And that's exactly what they did. It's the classic corporate playbook. Sell shares on the good news.
Capricorn announced a public offering. The goal? To raise $150 million.
This move, called dilution, basically opened the door for traders to bet against the stock's peak.
Okay, now let's dig into the numbers. This is where you see how intense the fight really got.
Get this, over a third of the company's tradable stock was being sold short. That's a huge bet.
Short interest is just a direct measure of how many people are betting the price will drop.
And look at that, it would take over 7 full trading days for all those shorts to buy back shares.
That days to cover number is a big deal. When it's high, it signals a lot of risk for shorts.
Why risky? Because any good news can trigger a short squeeze, forcing them all to buy at once. And here's the price of that bet, a crazy 118% annualized cost just to borrow the shares. You heard that right. It's incredibly expensive, which puts a ticking clock on their whole trade. So what you have is this incredible tactical tug of war between two very powerful opposing forces.
On one side, a real medical breakthrough. On the other, the simple market mechanics of more shares.
This tells us a few things. Big news creates chaos, and that high borrow cost acts like a timer.
So in this fight between a medical breakthrough and market mechanics, who's going to blink first? Today we're diving into Intellia Therapeutics, a company at the center of a fascinating market battle.
So why are so many people betting against a company that could literally cure genetic diseases?
Well, the company's valued at over $1 billion. That's a lot of hope baked in. But get this, more than a third of its stock is being bet against. That's a huge number.
Now, this isn't a bet on bankruptcy. It's just that the price is way ahead of reality.
Okay, so first, let's look at the bull case. Why are people so optimistic?
Their CRISPR tech is revolutionary. Plus, they have a strong drug candidate and growing partnership revenue.
And Wall Street analysts, they're pretty bullish, with some targets way higher than today's price.
All right, but what about the bears? They're focused on the long, expensive valley of death.
See, Intelia is burning through cash and won't see real sales until 2027 at the earliest.
We're talking about a cash burn of around $400 million a year. That's a serious clock. So for the short sellers, any kind of clinical delay is exactly what they're hoping for.
And recently, there were some red flags, safety signals, and a potential FDA clinical hold.
A hold like that would push their timeline back even further, burning even more cash. Big problem.
But you know what makes this short trade really tempting for the bears? It's all about the cost.
It costs less than 1% per year to bet against Intelia. That's incredibly cheap. So it's basically free for them to just sit and wait for their whole thesis to play out.
I mean, compare that to other speculative stocks. It's kind of a no-brainer for a patient bear. So you've got this epic standoff, groundbreaking science versus cold, hard financial reality. It's revolutionary tech versus massive cash burn and potential delays, a classic Wall Street battle.
But there's a catch for the bears. Days to cover is really high, at 9.5.
That means if any good news drops, all those shorts will scramble for the exit.
So, what's going to give first? The promise of medicine or the simple pull of financial gravity?
iRobot, you definitely know the name. But is this company about to go bust? Let's dig in. Yep, that iRobot. The folks who pioneered the whole robot vacuum thing with the Roomba. But lately, a ton of big money investors are betting that it's actually going to fail. Why? Well, for the bears, it's kind of a perfect storm. It's not just one thing, it's everything at once. First up, their sales are absolutely collapsing. Just look at that huge drop in a single year. And with sales down, the company is just bleeding money. A huge operating loss right there. Even the CEO had to admit it, they fell well below their own expectations. Ouch. On top of that, they've got a ton of unsold Roombas just piling up in warehouses. We're talking over $140 million of inventory just sitting there, literally collecting dust. But all of that pales in comparison to the biggest problem of all. They are running out of cash. As of late 2025, this is all the cash they had left. Just look at that number. That's not even enough to keep the lights on for one single quarter. That's a huge red flag. And this is straight from them. They have no other sources for more cash. None. So the market smells blood in the water, and investors are piling on to bet against them. Get this, a wild 42% of all their available shares are being shorted. That's a massive bet. And it's not slowing down. That short interest just keeps climbing month after month. But here's where it gets really interesting. All those shorts create a super volatile situation. It's like a coiled spring. And to see just how risky it is for the bears, you gotta look at a metric called days to cover. For iRobot, it's over 7 days. That is a long time to be stuck in a bad trade. So if any good news hits, it could trigger a mad scramble for the exit. A classic short squeeze. So you've got these two opposing forces, a company running out of money and a super risky, crowded short. It leaves you wondering, is iRobot about to collapse? Or could this huge bet against it actually save it?
Okay, let's talk about a widowmaker stock. It's a financial trap, and this one's called MNDR. Get this. Nearly 3/4 of this company's public shares are being bet against. That's a massive red flag.
And the cost for that bet? An absolutely insane 555% annualized fee, just to short the stock.
So how does a stock get this crazy? Well, it's not just about the company, it's about the market's wiring.
So let's dig into the fundamental warning signs that got the short sellers so interested in the first place.
First, the company suddenly pivoted from telehealth to AI data centers. Chasing buzzwords is rarely a good sign.
On top of that, it's incorporated offshore in the Cayman Islands. That raises all sorts of transparency questions. And then, they did a reverse stock split. That's a classic move that often comes before a big fall.
But these moves didn't just look bad, they actually engineered a powder keg situation with the stock itself.
That reverse split created a micro float, leaving less than 1 million shares out there for the public to trade.
With so few shares, even small trades can cause huge price swings. It's basically a magnet for manipulators.
This created a total pressure cooker. Short sellers ended up borrowing almost 3 out of every 4 shares available.
Because of that insane demand, the cost to borrow shares just went through the absolute roof.
At these rates, shorts are bleeding money, paying over 1.5% of their position every single day.
And all of this sets the stage for a really high-stakes game of chicken between the bulls and the bears. It's a vicious cycle. If the price rises at all, shorts are forced to buy back shares, pushing the price even higher.
And that's why this is a structural widowmaker. The danger isn't the company, it's the market mechanics.
The key takeaway here? Sometimes the stock setup, the plumbing of the market, matters way more than the business itself.
It's a perfect example of how sometimes the most important story is actually the structure of the game.